Your next reading is Introduction to Alternative Investment, and these are the specific learning outcome statements. So let us briefly discuss these one by one. Compare alternative investment with traditional investment. Well, when we say traditional investments, we are talking about investments in stocks, bonds, cash. So normally we hold long positions on publicly traded investments like these. So they are all most well known and used by many investors. But when we say alternative investments, so these are the investments outside the traditional pool of investment classes. So they include real estate, they might include derivatives, they might involve short selling of stocks, and so on and so forth. So some other characteristics of alternative investment. Alternative investments are illiquid. There is an element of illiquidity of the underlying investments because it is difficult to sell these investments in the short notice. Like if you hold property, it will take maybe a couple of months before the deal is finalized and the amount is collected in your account. So they are illiquid. So if you hold bonds and shares, you can sell them fairly easily. Next, narrow specialization. The manager holding these alternative investments is just specialized and focused in a particular type of investment only. Low correlation with the traditional investments. Yes, if you hold a piece of land, so the return on this property, they are not correlated with the returns on stocks. Low correlation with traditional investments. Then another characteristic of alternative investment is limited data. That is limited historical data, and because of limited data there are problems of calculating risks and returns. Then alternative investment markets are not as tightly regulated as your markets of traditional investments like bonds and stocks. So there is less regulation, and of course because of less regulation there is less transparency in alternative investment markets. And since these are unique transactions involving in alternative investments, loosely regulated, less transparent, so it would result in unique legal and tax consideration for such investments. Then the categories of alternative investment: hedge funds, private equity funds, real estate, commodities, and infrastructure. Let us discuss these one by one. Hedge funds are basically funds that hold a variety of traditional and alternative assets. They are often highly leveraged, and they seek absolute returns for its investors. Private equity funds. Private equity funds, they invest in non-publicly traded companies. And how do they invest them? Often with the leveraged buyouts of those companies that are profitable and that are generating sufficient cash. Then real estate. We'll discuss all these as we go along. Real estate includes investments in buildings and land through a variety of vehicles, including ownership or through mortgages or mortgage-backed securities. Then commodities. Commodities, investments in commodities are investments in physical goods such as oil, metals, agricultural products, along with their underlying securities such as forwards and futures. And then finally we have infrastructure. When we say infrastructure, means we are talking about roads, dams, bridges, so on and so forth. So we will discuss these briefly one by one as we go along. Your next LOS says describe hedge funds, private equity, real estate, commodities. Now we will discuss all of these one by one. Hedge funds. Hedge funds are private, actively managed investment vehicles that capitalize on various investments. They often use aggressive strategies across variety of asset classes. They use derivatives, high leverage, arbitrage, and other investment strategies that are normally not available to traditional fund managers. So the goal for hedge funds is to maximize short-term earnings. There are then certain restrictions. Once you invest in hedge funds, there is a certain lock-up period or a notice period that you have to give the notice to the hedge fund before you can withdraw the funds. So there are certain restrictions on the way you get the funds, your money out from such an investment. Hedge funds, first of all, they are not listed and they are not heavily regulated like your listed companies. So they are exempt from the Investment Companies Act 1940, and usually they have performance-based fee to attract the top managers. The size of hedge fund industry has grown tremendously over the last couple of decades, from about 500 billion in 2000 to about more than 3 trillion as at the end of 2020. Then private equity funds. Private equity funds, unlike hedge funds, which invest just about anything, private equity funds directly invest in companies, primarily by purchasing private companies. So frequently, private equity funds use leveraged buyouts to purchase companies that are currently in problem. Long-term focus. Yes, private equity funds, they focus on the long-term potential of the companies they invest in, so that when the companies do well, so their returns would increase. Deployment of funds. Private equity funds, they will typically deploy their funds assets in many small companies with this hope that at least one will offer significant returns to offset the risk of loss in other firms, in other investments. And often private equity funds, they take the services of a fund manager who may work alongside other corporate experts that is in charge of individual units. Then we have real estate. Real estate investments in property, typically owned via title deeds, often registered by the local government or the federal government, the land registry. So it has various types. It falls into many categories such as residential property, commercial property, industrial property, agricultural and timberland. Residential means the property used for dwelling by people. Commercial means where the business activity is conducted. Industrial, where the manufacturing process goes on. Agricultural, farmlands, and timberland, that is the forestry. No fixed maturity. Sure, property may be held for more than 100 years. And as I said, that in like other alternative investments, real estate investment are also quite inefficient compared to other markets such as equity. Reason is that they are quite illiquid. There is information asymmetry. Some people know everything about a certain piece of property, and others, they know nothing. This is not true for equity market. There is high information asymmetry in the real estate. So allowing those with the special knowledge, special information, they make much greater returns than those who don't. Returns from net income. Returns come in the form of net income from the property as well as the capital gains from any sales. For example, let's say the property purchased a few years ago at $100,000, sold at $150,000. So this $50,000 is what you call the capital gains. So this is where the returns come from. And yes, as I said, that real estate investments are fairly illiquid except the mortgage-backed securities. With the exception of real estate securities like mortgage-backed securities, liquidities in real estate market is low. Successful sale can sometimes take up to a couple of months, as I said in the previous slide. Then we have commodities. Commodities mean the gold, sugar, wheat, oil, cotton. So commodities, investments in commodities are largely due to existence of derivatives, especially futures and forwards. The good thing about investing in derivative is that you don't need to have the physical custody of the asset. Trading in commodity derivatives avoids storage. You don't need storage space, transportation cost associated with holding the underlying commodity. That is a good thing. And remember, commodities, they offer us a chance to hedge against inflation. Then infrastructure. When we say infrastructure, we talk about roads, dams, bridges. So infrastructure would attract those investors who want stable returns, not higher returns. They just want stability of returns. Then there are brownfield versus greenfield projects. What's the difference between these? Brownfield investments are those which are either being sold or leased by the current owner, often the government. Existing investments in infrastructure is the brownfield investment. But when you say greenfield investments, these are new projects. And as I said, that investments in bridges, tunnels, roads, communication equipments, factories, they all fall within the infrastructure. Now next, describe the potential benefits of alternative investment in the context of portfolio management. The first benefit is diversification. Why? Because alternative investment, it has low correlation to traditional investment. Because if you hold a piece of property, or if you hold investment in a road, the return on these investments, they have almost no correlation with the return in the equity market. So hence they will help you reduce the portfolio volatility. Second, alternative investments, they offer you higher returns than the traditional investments. When that would be true, especially when there are lower interest rates. During the periods of low interest rates, your alternative investments can offer you higher returns. And then finally, growth. Investing in alternative assets investments provides access to a much broader set of investments, which may help grow your overall returns on your investment. So these are the benefits of alternative investment. Then next LOS says describe, calculate and interpret management and incentive fee and net of fee returns to hedge funds. First, hedge fund fee are usually twofold. The first is the management fee and the second is the incentive fee. Now what's the difference between these two? Management fee is usually based on the total value of assets under management, and it is earned irrespective whatever that. Let's say the assets under management are 100 million at the end of the year. So the management fee is, let's say, 2% of this amount. So that will be $2 million. Whereas the incentive fee, it is usually based on the returns earned. If this fund has moved from 80 to 100 million, that means 20 million return was generated. So in this case, the incentive fee could be 5% of 20 million. That is the return generated by the funds, right? Or it could be calculated net off. We'll see in the example as we. So in case if the fund makes a loss, so there will be no incentive fee. Incentive fee is usually payable when there are returns generated by the funds. Then high watermark provision. What's that? Means, let's say if the value of the fund at the end of the last year was 200 million and now the value of the fund has moved up to 250 million. So you would be paid only on this differential. If the net asset value is higher than the previous one, so this 50 million, that would be the basis for calculating your incentive fee. So high watermark is typically the highest value reported by the fund. And let's say if the value of the fund falls to 230 and then it goes up to 280, then this is not the differential on which the incentive fee would be paid. The incentive fee would be paid on this difference between the previous highest and the current highest, not from 230 versus 280. That's an important point we will see as we go along. So it's normally it's quoted like 2 and 20 fee structure, that is 2% management fee and 20% incentive fee. The incentive fee, it may be calculated separately or net of the management fee, and this we are going to see in a good example, all the computations involving the management fee, incentive fee, watermark, return on the funds and all that in the next example. Now here we go. High returns Hedge fund has 100 million in assets under management at the start of the period 1. So this is the starting value of the fund, 100 million. The fund grows to 120 million at the end of year period 1. At the end of period 2, the fund falls to 90 million. And then in period 3, the final valuation for the fund asset is 140. So interesting, 100 million to 120, 120 to 90, and then 90 to 140. If incentive fee are not calculated based on net of management fee, calculate the return to investors at the end of each period given a 220 fee structure. That is 2% is the management fee, 20% is the incentive fee with a high watermark provision for incentive fee. Okay, now let's do the simple computations. First of all, there has been a growth of 100 to 120 in period 1. So the growth of 20 million. So this is the increase in the period 1 from 100 to 120, which means this will attract incentive fee of 20%. We'll see as we go along. So let us first calculate the management fee, which is 2% of the value at the end of the period. Since the value at the end of the period was 120, so management fee would be 2% of 120, that is 2.4 million. Now let us calculate the incentive fee. Incentive fee is the growth in the fund, which is 20 million times the incentive fee percentage, that is 20%. So it's going to be 20 million's 20%, that is 4 million. Now what is the total amount of fee, management fee, incentive fee? 2.4 million is the management fee and 4 million is the incentive fee. So the total payable is 6.4 million. Now let us calculate the return to the investors. Since the fund growth is 20 million, out of which 6.4 million is payable to the fund management fee and the incentive fee. So the net return generated would be 20, the growth, less 6.4 million, divided by the initial value of the fund. So that will be 13.6%. It's fairly straightforward computation. Now let us move on to the second year. What happened in the second year? The fund fell from 120 to 90. So there has been a negative growth in the funds, that is 120 and 90 is different, that is negative 30 million. Now in this case, what would be the management fee? The management fee is a straightforward 2% of the assets under management at the end of the particular period. So it's going to be 90 million's 2%. Management fee is 2% of the assets under management, that is 1.8 million. Since the fund value has fallen from 120 to 90, no incentive fee is payable since the fund has not reached the high water mark of 120. It is below this high water mark, so there is no incentive fee. So the total fee would just be 1.8 million. And what would be the return on the funds? Of course, negative returns. Negative 30 million, the negative growth in the fund, and 1.8 million fee to the fund management fee. So if you divide this with the beginning value of the fund, so there has been a negative return to the investor of 26.5. Then the last part to this, the third year. Now the fund grows from 90 million to 140 million. So there have been a growth of 50 million. Let us first calculate the management fee, which is going to be 2% of 140 million. 2% of the assets under management, that is 2.8 million. Remember, even the fund has moved from 90 to 140. The incentive fee would be based on the higher water mark, that is 120 versus 140, not 90 versus 140. That's an important point. So the growth compared to the previous high water mark was 120 versus 140, 20 million. So the incentive fee would be paid on this 20 million. 20 million's 20% gives you 4 million. So the total fee payable would be 6.8 million. Total fee for the period is 6.8 million. Now return to the investor this time would be, there has been a growth of 50 million, less 6.8 million as the fee. Net amount divided by the value of the fund at the start gives you 48% return over the period 3. Now what if we calculate the total returns for all these periods? The fund has grown from 100 at the start of year 1 to 140 at the end of year 3. So there has been an overall growth of 40 million. The management fee paid in all these years is 7 million. Incentive fee in all these years 8 million. So now you can calculate the total fee paid, management fee and the incentive fee and the overall return to the investor. This is how we can calculate. This is the total fee paid 7 and 8, that is 15 million. So the growth has been 40 million over the 3 years period, and out of which 15 million has been paid as the management incentive fee. So the net return for the investor is 40 minus 15 upon 100, that is 25%. So that's how we calculate the various returns to investors and management and incentive fee accordingly. So moving on to the next LOS, describe issues in valuing and calculating returns on hedge funds, private equity, real estate, commodities, and infrastructure. Okay, first, issues in valuing and calculating returns on hedge funds. First, exit or redemption. When a fund is performing poorly, investors they may decide to exit completely, or they may redeem a fraction of their investment or fraction of their shares. What it would do, it will force the fund to sell some of the assets, and if this fund is in trouble, the fund may be selling it at a low cost, so transactional cost would be high, so it will further magnify the losses for the funds. Then price quotes used. Funds vary significantly from each other with regarding to price quotes. When market prices or quotes are used for valuation, funds may differ which price or quotes they use. For example, they might use a bid price or ask price or average quote or a median quote, but the common practice is that the average quote is used, that is the bid plus ask upon 2. Then we have commodities. Issues in valuing and calculating returns on commodities. Valuation of commodities depends on various factors. Valuation depends upon quality, depends upon the quantity in total, the grade of the commodity, which grade the commodity belongs to, location of delivery, time of delivery, and many other factors. And of course, storage cost and the convenience yield, they must also be taken into account. So these might be the issues in valuing and calculating returns on commodities. Then we have infrastructure. Issues in valuing and calculating returns on infrastructure. For the purpose of valuation of infrastructure, there has to be a good knowledge of regulatory risk, because it heavily relies on the knowledge of regulatory risk, construction risk, and of course the reliability of cash flows. Cash flows from tolls, from utility prices, and since the cash flows are pretty stable for infrastructure projects, returns are often reliable, but heavy regulations on profits and services under the law can hurt, it can put the business in trouble. Then describe risk management of alternative investment. To make the most of alternative investment to draw as much benefit as possible, due diligence is the key. The investor should look at issues such as funds track records, how well the funds have performed over the years, the investment horizon of the fund, and redemption and payback rules, and most importantly, the integrity of the management. The investor should study the market forces, the forces of demand and supply, before investing in a particular alternative investment. And the investor must consider various types of risk involved, most importantly, the risk of liquidity. And there is an overriding consideration before making any alternative investment. Investments in alternative vehicles should always be viewed as a way to diversify your portfolio. How well investments in alternatives can diversify your portfolio in a most efficient manner. So that ends your introduction to alternative investment reading.